Hello and welcome back to Industry Insights, exclusive interviews from Octis. I'm Armie Lee, an assistant editor for deal origination here at Octis, and I'll be stepping in for Julie Miacamp, who is away this week, and I'm glad to help set up today's conversation. On this podcast, we sit down with leaders, experts, and decision makers across industries to go beyond the headlines and dig into the ideas, trends, and market forces shaping the business landscape right now. Today's episode features Tyler Gately, head of North America Private Credit at Barings. Private credit has been in the spotlight because of factors including concerns over lenders' exposure to software companies as artificial intelligence evolves, and it was interesting to hear Tyler's perspective. In this conversation, you'll hear more about what's happening across private credit and direct lending, how investors are thinking about risk and opportunity in the current environment, and some of the broader shifts shaping the market. Tyler talked about the market being in price discovery mode for the first time in a number of years. He also shared his views on topics including AI and software. Before we begin, a quick note. The views expressed in this conversation are those of individuals speaking and do not necessarily reflect the views of Octis. This podcast is for informational purposes only and should not be considered investment, legal, or financial advice. Here's the conversation with Tyler. Enjoy. I am here with Tyler Gately, head of the North America Private Credit business at Barings. Tyler started his career at Bank of America Merrill Lynch, spent time at Plexus Capital, and then moved to Wells Fargo Securities, where he worked as a senior high-yield analyst covering energy, metals, mining, and chemicals. He joined Barings in 2018 and since 2024 has led the North America Private Credit business. Tyler, thanks for being here.
Thanks so much for having me.
Let's start with where we are. It's late March, the first quarter is wrapping up. It has been a noisy few months. How would you describe the direct lending market right now? Are things loosening up, or does it still feel cautious out there?
Any headlines out there about private credit these days? It's been interesting. I think Q1 is seasonally typically the slowest. However, with I think a lot of kind of ramp up in attention, particularly out of the media, I would say if you believed everything you read, it would be just total chaos in the market. I think the truth is, both on the deal side and in the portfolios, it's relatively benign, pretty orderly and kind of business as usual. Nothing all that exciting at the end of the day, but I would argue that's also what people sign up for with private credit to begin with.
What are you seeing in terms of volume and deal activity? Is it picking up?
You really have to kind of take a step back and bifurcate new platform activity with add-on activity. Zooming out at the new platform landscape, again, seasonally relatively slow, but that backlog continues to build. From a macro perspective, I think I've seen there are over 13,000 private equity portfolio companies out there. So those have to turn over. You're matching that with historical highs in private equity dry powder. So I think the market is primed for a ramp up in new platform activity. We just haven't really seen it. Last year was a little bit better sequentially over 2024, but we're really just kind of waiting for, I'd say, the removal of some of the macro headwinds or geopolitical tensions, you name it. There seems to always be something around this time of year. But new platform, again, it's just a little bit slower than you'd like it to be. That being said, when you flip to the add-on side of things, typically that is amongst the biggest opportunities for large established private credit platforms because you're really deploying into your portfolio more often than not in non-competitive kind of off-market transactions. Add-on activity continues to hum along pretty nicely. I think structurally speaking, it's a defensive play for sponsors as well. Over the past couple of years, platform multiples have continued to come down. So what's the best defensive play? And that's a bunch of add-on acquisitions at lower multiples, bringing down your cost basis. So I think you've continued to see add-on activity around that. Order of magnitude, probably 60 to 70% of the dollars going out the door right now are probably supporting that. So we're busy, but not necessarily the big splashy things that are going to end up on the front page of anything.
In the backdrop that you laid out, where do spreads sit right now compared to where they were 6 months ago?
It's interesting. I would say we're really in price discovery mode for the first time in a number of years in our market. I was talking to a couple of investors the other day and kind of hit me that this is really the quickest re-rating and pricing that we've seen in our market, arguably since COVID, which again was pretty dramatic in a pretty short period of time. So to put context around that, in probably the last 2 months, we've seen spreads gap out 50 to 100 basis points and OIDs back out another 50 or 100 basis points. I think what's driving all of that is candidly the BDC market. Looking back over the past couple of years, the marginal dollar in just about every deal in our marketplace has come from the retail investor and these perpetual products putting pressure on spreads and structures. And in a rather short period of time, that dollar has disappeared. So when we think about kind of the opportunity set, predominantly institutional capital bases like Barings, this is arguably as attractive an opportunity as we've seen, again, since COVID. So I say all of that. Don't want to sound too alarmist on one side or too optimistic on the other. The opportunity to actually deploy into that is equally small. I think deal flow, to my point earlier, is a little bit slower than you'd like it to be. A lot of the topics we'll probably get into, over the next, 30 minutes are really around kind of who has access to that. And I think that list of GPs that can actually deploy and take advantage of a dislocation like this just continues to shrink, particularly when you remove platforms that are over-indexed to the retail dollar.
And as we head into, and you touched on this earlier, if you can maybe expound on it further, how is the pipeline looking as we head into the second quarter?
It's mixed, to be honest with you. One of the big trends that you'll see is hold periods for private equity firms will continue to get kicked out, particularly when you think about any of these kind of higher flying assets like the software businesses that were, for all intents and purposes, the darling of the private credit space for a long period of time. Now they're dealing with structural headwinds and disintermediation risk with AI coming in. We had one software sponsor the other day tell us that this probably extends their hold periods 18 or 24 months, best case. I'd say all that to anchor you around the quality of deals is mixed. I think some of the higher quality assets of yesterday are probably just holding on for better markets to sell into. That being said, to my points earlier around dry powder in the market, the amount of capital that needs to get realized and returned to LPs continues to build. So when I look at Q2, I think quality is going to be mixed, but I do anticipate the volume to continue to pick up.
People have been predicting, that M&A will be coming back. Given, the dynamics you had mentioned, does that feel realistic to you? A big bounce back maybe in the back half of the year?
I probably would have said we're going to see it bounce back in the near term for the past 3 years. So I'll steer clear of any kind of grand forecast here, but I do expect it to generally kind of creep along. I think, again, it's probably more of an access question than a step change function in actual flow. I don't expect the 2021 type deployment year for us or anybody at the end of the day. I think that's more driven by private equity activity than it is private credit GP appetite. But again, with the headwinds on the sponsor side of things, with multiple compression, with equity stories just not really playing out the way that folks really wanted them to, you kind of have this bifurcation, and the really strong performing assets aren't getting the valuations they think they want. So you're starting to see CV activity pick up. And then you have the assets that are just puttering along and not really doing a whole lot. Equally, they're going to wait for a better day and hopefully they can turn their more organic performance around. So long-winded way of saying, do not expect this massive return to the flow that we saw in 21 and 22. But at the same time, I don't think that's necessarily a bad thing. What you'll see when you start looking through a lot of the portfolios is the pressure points are a lot of assets from 21 and 22. When markets were so hot that you had, I'd say, less disciplined behavior really in all parts of the capital stack on the equity and the debt side.
Yeah, 2021 was such an outlier year, wasn't it?
Yeah, it was fun while it lasted, but I think those that kind of stayed disciplined and on strategy are going to see the benefits out of that. I'm cautiously optimistic that vintage may be the one that actually starts driving the divergence in GP performance across private credit specifically. But I'll not going to hold my breath on that. But I think that is one, particularly with evolution of structures, like the utilization of ARR loans and the like, that's really where you're starting to see the pressure and the very acute headwinds from AI and a lot of this tech pressure. It's all kind of percolating around that. So I think it's good lesson in discipline, and hopefully the market hears that and gets back on track.
You mentioned, Tyler, the BDC market is a big driver where spreads went. And what is happening now that the retail dollar has pulled back? So how significant is that shift? And what does it actually mean for platforms like Barings that are running more institutional capital?
So what does it mean? I think we touched on it a little bit earlier around just kind of the short-term impact on pricing. I think ironically, spreads and pricing are arguably more attractive the larger the business because those sponsors have been more and more reliant on those types of platforms. We had one example that comes to mind where we were shown a deal. We loved the asset. The pricing didn't make any sense to us. So we passed on it. About 2 weeks later, we got called and said, would you do it 200 bips back of that? And it wasn't a 25 basis point move. It was just kind of a full reset of that market in a rather short period of time. So I think, what does it mean to platforms like Barings? Candidly, I think the makeup of your capital base being institutional in nature means everything. When we're not going to be the only ones that have that makeup. However, when we see opportunities like that for large, stable, performing assets where we can lean on structure and we can drive better documentation and better terms while also picking up a couple of 100 basis points in the process just because of our capital base, that is a meaningful opportunity for our LPs that other platforms, structurally speaking, won't have the ability to lean into. That's really where we get so excited, and we deploy a ton of our own capital into every deal that we do. Speaking for, our own capital, this is exactly what we try and get into and get excited about when we see it. We just haven't seen something this meaningful in years. So, long-winded way of saying, if you're structured the right way, if you're capitalized in the right way, now is a fantastic opportunity.
To get into AI and software, you touched on this a little bit earlier, and I think it's worth really getting into because it's generally changing how people are thinking about this asset class. Software has been such a core part of direct lending for years. And how are you actually thinking about what AI means for the borrowers you're lending to today?
It's funny, I made the comparison earlier to what pricing and structures have done relative to the onset of COVID. The market reaction, particularly in private credit and a lot of the media headlines around that, not all that dissimilar to COVID. And I mean, we were experiencing something new. The onset of that seemed incredibly rapid. And the uncertainty around that candidly just stewed a lot of fear in the marketplace. I think that at a macro level is entirely overblown. What we're experiencing today is really more of an equity risk than it is anything. And it also ignores the whole concept that all of these software businesses have been investing in AI themselves. And candidly, the vast majority view this as a tailwind. That's not to say there's not risk there, but I don't see a lot of headlines about the equity side who's going to wear the first loss, and a pretty meaningful one at that, with the media attention on private credit. Again, structural reasons why, when folks were lending off of revenue and so on and so forth. But at the end of the day, feel really good about where we are and how we're positioned. When we look at new deals, and I think that was kind of the root of your initial question, we tend to avoid horizontal software. We tend to look at more vertical software, system of record, something that has a compliance or a regulatory lean to it. That level of stickiness and entrenchment into the ultimate enterprise is absolutely critical in really defining what that competitive moat is relative to the risk of AI coming in and replacing. So what are we doing there? I mentioned price discovery a number of times. That's really where we're seeing the most price discovery in the market right now. There are GPs out there on the private credit side that are just out altogether. We've had sponsors call and just say in black and white terms, are you able to invest in software today? And our answer is a resounding yes. However, institutionally speaking, we also want to take a step back and be intellectually honest about what we are at the end of the day. And that's, we're investors. We're not software tech people. So what have we done? We've engaged third-party consultants who can come in and actually underwrite the product level of these businesses and opine on their defensibility and their competitive moat relative to disruption from AI. So we're trying to get more comfort around the asset or the actual product. But then given our capital base that we talked about earlier, I think it's a tremendous opportunity to lean in and take advantage of otherwise very defensive assets at dislocated pricing and structures.
And speaking of leaning in, when you're sitting across the table from a software borrower today, what are some of the specific questions you're asking now that you were not asking, say, 2 years ago?
Honestly, how they're thinking about AI. As simple as that is, I mentioned a moment ago that a lot of these businesses are seeing this as a massive tailwind, and some should be seeing it as a massive headwind. We were discussing one business at IC the other day, and my knee-jerk reaction was, I'm pretty sure I could create an app that does this tomorrow using some of these tools that we've seen coming out of the AI community. And that's something that wouldn't have crossed any of our minds 18 months ago, 2 years ago. So overlaying just an unchanged underwriting and investment philosophy with this new lens, it's a similar exercise that we've used over the past couple of years when you start thinking about supply chain challenges coming out of COVID, the rollout of tariffs and what that meant, rising base rates. We have to look at our portfolio and we have to look at new investment opportunities through a refreshed lens. However, the underlying strategy and again, the basic investment philosophy is unchanged.
There's also a valuation piece here. Software multiples got very stretched in the rate environment we just came through. As you are underwriting deals today, how do you think about where multiples should be? Are sponsors and lenders aligned on that?
Yeah, not entirely aligned. And I think that's a healthy viewpoint. When we look at it, whether it be the initial underwrite, where incurrence tests fall, where covenants fall, we need to be well inside of our view of EV. It can be a modest de-risking dynamic if the sponsor is willing to pay 25 times. It tells us that there's a heck of a lot of skin in the game behind us. But at the end of the day, our recovery is what we're focused on in a downside scenario. So when we look at it, we have to be a little bit more, I'd say, strained in that exercise. You kind of touch on the dynamic indirectly, and I think there is still a pretty meaningful bid-ask spread in the market when you start looking at high-growth companies that 2-3 years ago were commanding multiples in the mid-upper 20s, right? Even if organic growth has continued to truck along, the multiple to sell that at in today's market is meaningfully lower. I mentioned the rationale for some private equity firms leaning into the CV market. Honestly, I think the CV market is a great opportunity for us. More often than not, what you're experiencing in that is you're validating a new valuation point with new equity coming in. You've already kind of de-risked the initial LBO, right? And you've also seen that business play out their strategy. So if it is one of the winners and not just a play to kick the can down the road on something, then it can actually be a great opportunity to invest. But we still have to think in a more, maybe not draconian, but a pretty stressed downside scenario. If multiples continue to contract, AI does cause some meaningful disruption to this industry or this subsector of software. What does the recovery playbook look like for us? And I think that part is continuing to evolve. I don't think we have everything figured out with AI and how that's going to impact the software ecosystem. Generally speaking, we have to be a little bit more bearish. We're glass half empty kind of folks on the credit side. So, we'll leave them to opine on the 20-something multiples. If we're going to get our 5 times back, then we're good.
Let's talk about Barings as a business. Direct lending is one piece of the broader private credit platform. How does that integration actually work in practice? And what does it mean for you as you source deals, structure them, and hold on to relationships over time?
That's something that we're incredibly proud of, and that's just the broader reach of Barings. We're roughly $500 billion in AUM, but the vast majority of that is credit. So we have about $210 billion supporting sponsors in some way, shape, or form. What we've tried to do, and I think it's started to resonate more and more with the private equity community, is we've effectively replaced and reconstructed the banking landscape for the sponsor community. What does that mean? So we can do a simple first lien deal in a middle market function. When that business grows up, we can be the anchor execution, the high yield and syndicated loan side of the world. We can finance storied credits or businesses that kind of have some hair to it. We can do a NAV loan against the portfolio. We can do infrastructure or asset-backed type financings for them. And we've also been an LP in over 300 private equity funds. So when we think about anything from equity co-invest, LP support, all the way to middle of the fairway, direct lending type deals, it is a single call to one person. It's not having to have a Rolodex of 50 different GPs that you're trying to navigate, piecing together a capital stack. I think we can really approach that relationship through a solutions provider mindset, as opposed to just no matter what you ask for, this is what I'm going to offer you.
Fundraising has been a defining theme across private credit. Some managers are pulling in capital with ease, whereas some others are struggling to hold their targets. Without getting into specific fund details, how would you characterize the capital raising environment right now? What are LPs actually looking for?
Yeah, so taking a step back, one of the biggest trends in private credit as a whole has been just a continued organic consolidation. Take the M&A activity out. What you've seen over the past 5 years is pretty remarkable. 5 years ago, the top 20 managers raised about 30 to 35% of the capital. Last year, it was over 70%. So when you think about that, it goes back to one of the comments I made earlier around access to this. There are dollars to put to work from hundreds of different GPs, but the access point to lead agent roles, folks that control a process and actually manage consistent portfolios, is getting fewer and further between. What does that mean in today's market where there are headlines and there are, I'd say, differing stories around private credit from the GP's experience perspective? It's kind of a tale of two worlds between a retail style allocator and an institutional one. Spent a couple of weeks in Europe and Asia not long ago, and the big themes that came out of that to me were, if you are solely focused on investing in perpetual products, I think you're layering in a new perceived risk of liquidity risk in that. And I don't think really anybody had, at least folks that I was meeting with, had all that meaningful fear of the underlying portfolio. There was a concern of, if I need this money, is it going to be there tomorrow? My answer to that is BDCs as a whole are doing exactly what they said they would do. Obviously, nobody likes to hear the concept of a gate, but all of these BDCs are investing in illiquid underlying loans, and they're providing 5% plus in liquidity. So I think the challenge is potentially where GPs maybe promise more than they would otherwise provide, or investors just didn't necessarily understand what they were getting into. But I think the vehicles themselves are operating exactly like they should. So that's really on the retail side. There's maybe some yellow lights around that part of the market. On the institutional side, candidly, there is a tremendous amount of excitement. There is a little bit of a challenge in terms of a lot of the older allocators are full. So they're kind of waiting for capital to come back so they can recycle it into what will likely be a more attractive vintage. But this might be surprising to some. There are still a lot of new allocators out there, and some that are really quite meaningful in size. So when they look at it, honestly, the biggest theme there is, how do I get access in a rather short period of time? And again, we kind of get back to the notion of the value of these large scale platforms like Barings, where we can kind of get creative and find ways to get you exposure into today's vintage deals and collateral in a more efficient way. But I do think that the retail investor, that maybe the less sophisticated investor, or the less informed about private credit specifically, is maybe a bit more cautious, whereas the more savvy or the more developed allocators are really kind of licking their chops here.
Interesting. So it really is a tale of two markets right now for the LP that is trying to make a smart allocation decision. What actually separates a platform worth committing to from one that just looks good on paper?
Honestly, I boil it down to two things. One is consistency and discipline. We touched a little bit a moment ago about kind of that 2021, 2022 vintage, where it was kind of the year of what could go wrong. You started to see more venture lending. You started to see more ARR lending, more structured equity coming out of private credit shops. I think that's just more indicative of, I got flush with cash and I'm going to try and find different excuses to invest in more aggressive structures. I'm going to name it something different. I'm going to say I'm picking up 50 bips here. And ultimately, if you're in a first lien position, 50 bips of price for a lot more risk is not really worth it. So I think discipline is really important for LPs trying to parse through the data. That's really the challenging part around that piece. Is I think you can see a lot of funds that in aggregate look like they perform quite well. There's some structural protections around that, and how a manager might access leverage and how they might structure the fund specifically, that it might look like it's going to be a decent outcome, assuming the carrying values are real. But when you go line by line in a manager's track record and look at actual discipline, are they deploying into a consistent company size, consistent structures, consistent leverage profiles? That's where you kind of get a sense for what kind of an asset manager is this? Just trying to grow AUM at all costs, or is this kind of a long-term allocator? I think the other piece is really control. And what I mean by that is, one of the common refrains that every private credit manager is going to say in front of an LP is, the benefits of private credit is access to information. We're directly sourcing, negotiating, structuring. We're managing the downside. Most of that's true for everybody. However, actual control of the deal, and importantly, control of the outcome in a scenario where a portfolio company doesn't perform as expected, really only sits with the couple that are controlling that capital stack. So being with a manager who's going to consistently be the lead agent or the co-lead agent on more and more in the upper middle market, where you might have 25 or 30 managers in the same deal, 2 or 3 probably have influence. I think the others, if you're getting exposure that way through LP ticket to kind of an and me and manager on the tail there, you could be on the outside looking in a workout scenario. And that example and that situation doesn't really feel all that different than a syndicated experience in a workout. You're kind of in the club or you're not. And I think that's really where we find consistent, repeatable value in the traditional part of the middle market, because it's just smaller deals and smaller clubs. But also, we're going to be the lead or co-lead on over 90% of the deals we do. So that's really, really important to us to avoid downside. We can't grow NAV in a first lien security. We can destroy it really quickly with principal loss. So that's really kind of core to the approach. And I think it's kind of a hat tip to what's appropriate and a hold to maturity structure too. We don't have liquidity. We can't get out overnight. So we have to assume we're holding this thing until we get our dollar back. And we have to have those structural protections in place to execute on that mandate.
Thank you, Tyler. That is a really good place to pivot to the big picture. As you look toward the end of the year and towards the rest of 2026, what is your base case for direct lending? Are we turning a corner or still grinding through it?
I'll lean into the still grinding through it. And I'll maybe put a different word on it. And I'd say the rest of 2026, relative to private credit standards, is going to be a volatile year. And that has less to do with the available deals in the market and much more to do with the available capital pursuing those deals. When I think about volatile, that has negative connotations to it. I think that it is a fantastic opportunity for institutional, long-term, stable capital. It will be fascinating to see how liquid markets respond. If you can get a more functional syndicated market, that can kind of retake some share from the upper part of the middle market where you see capital kind of dry up. But again, when you think about the long-term buy and hold approach with institutional capital, I would argue 2026 is going to be as attractive as any year we've seen if the deals are showing up. And my base case is you probably see BDCs just think through things and with a bit more of a cautionary tone. Even if you start seeing the outflows slow down, my guess is you're going to see inflows also slow down. And at the same time, GPs not necessarily extending themselves all that aggressively on the new deal deployment. So maybe they were showing up for 500 million in a deal. Let's do 250 now, right? So I think you start to see a little bit of a balancing in the market, which even for that 250 in some of these upper middle market players, that will accrue to their benefit as well. So if they're doing something more cautious, so is everybody else. And I think you start seeing pricing and structures normalize a little bit across the entirety of private credit, not just where we tend to focus.
And I heard you use the word volatile, Tyler. Not in a bad way, at least not for everyone. So who actually wins in that environment and who gets left behind?
So if you can kind of take the step back and look at the fundamentals of the majority of these credit platforms are still incredibly sound. I'm not just talking Barings' book. I would say the vast majority of institutional quality shops are still incredibly well positioned. They have very sound portfolios. They're responding to structural needs of specific vehicles, not flashing red lights saying we're in real trouble. And that's something that we really need to be cognizant of when we point all these spotlights at the asset class. There's nothing structurally impaired in the asset class. You have something that was candidly inevitable when you start bringing in a retail buyer that isn't going to have the same long-term approach that the underlying asset kind of requires. That's not to say that it's inherently bad either. I just think there needs to be that intellectual honesty of the provision of liquidity on one end should be matching the liquidity profile of the underlying asset. And that's what folks should be selling to the retail investor, not everything's always available no matter what. It is if managers are forced to go sell into a market and take a loss on a performing deal that otherwise would have been worth par.
Before we get to the rapid fire questions, I want to spend a few minutes on your path. You came into the finance world in 2008, which is either the worst possible timing or the best possible education, depending on how you look at it. What did entering the market during the financial crisis teach you that you could not have learned any other way?
That's a great question. I'd say what it taught me is not every platform is going to have the same lived experience. And that I saw an article the other day, and I know we're talking about my career path, but I'll just totally bring this right back to private credit. But for every countrywide, there's a Wells Fargo, right? That weather the issues well. Did they have issues in their portfolio? Sure, right? but they emerged winners. So I think it's really important to exhibit discipline in all parts of the cycle because things will inevitably get bad. I mean, I mentioned credit investors tend to have a glass half empty approach to life. I think that's exactly what our investors want us to have. But we also have to understand that there will be problems. How we behave in 2021, 2022 will dictate how successful our platform is going to be in 2035. The long-term approach is the right one. It's really easy to get swept up in headlines and really easy to get swept up in the day-to-day volatility. And I think 2008 was a great example of that, where I remember sitting in the office looking at the TV screen and it was a bloodbath, right? And you didn't really know which way was up. But at the same time, if you were methodical about investing as things went down and as things went back up, you're probably looking really good right now. So I think, bringing a little bit of stability and maybe a bit more of a muted disposition to investing is likely the right play longer term.
Well, did it change the way you think about credit risk permanently, or do those lessons fade in good markets?
Yeah, same point around the discipline. I think it does inform, right? I think at the end of the day, we all have different lived experiences and we all have different perspectives that we're bringing to the table. And if you're not informed by what you've lived through, then I think it's a wasted experience. Chaos is a great opportunity. Chaos can be a ladder and chaos can crush you. What you don't want to do is have chaos be a missed opportunity. It is kind of a good reminder of this is a long-term play. And I also think, broadly speaking, what did come about from the financial crisis that we're still living today in private credit is just a full seismic shift in the capital markets landscape. But that's a long-term evolution. That's on the equity side, that's taken 40, 50 years for private equity to cannibalize roughly 50% of public equity markets. I think we're pretty early days for us, but you have to think long-term about it as opposed to this being a trade. And whether it's just my personality or not, that's always resonated with me. I've worked on liquid markets in the past. I just never got excited about, something moving 5 basis points. That isn't really fun for me. But longer term, there are trends that you want to get behind. And I think discipline allows you to do that, understanding you're going to have like an ebb and flow over that period of time, that you'll have some good days and some bad days, but long term, there should be the same North Star.
And so direct lending has changed enormously since you started. It was a small relationship-driven niche. Now it's a global asset class with institutional capital from every corner. How do you hold on to what made this market work in the first place as it scales to this size?
You mentioned the word relationships. I think that still truly matters. I would say to some extent that relationship has evolved from an individual's Rolodex to a platform. I mentioned earlier, our approach to working with the sponsor community is we want one person to be your call to solve every type of financing need that you may have. I think that relationship is critical. But I think going from how you kind of articulated it, in 15, 20 years ago, it was a relationship market that was really consolidated around GE Capital and Heller Financial and, very few places. Every one of those has dispersed across the market, and then it's become more and more institutionalized in nature. It's just structurally changed. But with that has come a maturity in the market, a stability in the market. And that allows us to be, I'd say, a bit more stable in our performance. And while efficiency isn't always good from a pricing perspective, I do think it allows for better transparency and a better investor experience at the end of the day as well.
And before we wrap up, I want to do a few quick ones. Short answers, Tyler. First thing that comes to mind. Are you ready?
Let's do it.
One thing you have changed your mind about in the last 10 years.
And this is probably a byproduct, and this is going to sound cheesy, but probably a byproduct of the experience I've had working at Barings. People matter a lot more than what you're doing. Kind of gone from, really large shops to small shops and all around. I've had toxic bosses and I've had fantastic bosses. I've had groups that I love working with and groups that I'm ready to tap out at whatever time every day and go back home. People are what make it work. And I think we are just incredibly fortunate to have a truly great culture of good human beings here that makes it exciting. And, again, when I was younger and, I'd like to say I was transitioning out of that view by the time I joined Barings, but I was very focused on what was the brand name on my resume. And it was a stepping stone, right? But I think, at the end of the day, who you work with is going to dictate how you do it and will dictate ultimate performance at the end of the day. And again, couldn't be more thankful for the folks that we get to work with at Barings.
One market trend you're watching most closely right now?
Perpetual BDC inflows and outflows.
One thing young professionals in credit consistently underestimate?
Downside risk. Young professionals, more often than not, still have whether they like to admit it or not, an equity-oriented mindset. I'm reading what the investment bank sim says and I'm buying it. And it's, everything is up and to the right. There are a lot of businesses that you'll see that get financing in our market that have little to no reason to exist. But at first blush, it's the greatest business in the world.
Best piece of advice you received early in your career?
Coming out of my first job, doing the standard kind of 2-year analyst program, you're looking for the next thing. And I was really pigeonholing myself around, I did X for my first job, so I'm going to do X for my second job. And somebody mentioned to me, stop focusing on your widget and start thinking about what you're actually good at as a person. That helped me kind of take a step back and say, yeah, I was good at LevFin, but that's not the end all be all for me. How am I going to separate myself relative to the next person? And I think kind of looking inward is every bit as important as looking at the book in front of you or the role that you're doing in any one day.
One financing misconception you wish would just disappear?
Somebody that will go unnamed referenced private credit being full of cockroaches. So
I think I know who you were talking about, but you should remain unnamed, of course.
It's nice when you earn the oracle status in the world and people just take you at your word. But yeah, I think that's a pretty big misunderstanding of what's going on.
Tyler, thank you so much. That was really helpful. And I feel like we only scratched the surface on some of these topics. So hopefully we can do it again. I really appreciate your taking the time.
Yeah, thanks so much for having me, guys.